Mark, when you look at the jobs data, when you look at the expectation for what we might get in terms of CPI on Wednesday, is consensus underpricing the risk of more surprises and cost pressures?
Probably so, because the CPI numbers only tell a part of the story, and as I pointed out many times before, the CPI is a very inaccurate measure of what is really happening in the economy. If you consider the fact that the money supply in America went up by over 30% last year, you have to expect prices to go up by that much. The good news, of course, is that technology pushes prices down, but the reality is that, in fact, those 7% numbers are probably underestimating what is coming down the pike. So we can expect higher prices, but of course, higher wages, because you can see unemployment is down and people will be getting more money. So you're going to see a balancing of these two forces as we go forward.
I'm looking at what's happening with U.S. Treasuries, and we picked up where we left off on Friday with higher yields. The 10-year futures now at the lowest level since December of 2019, bonds under pressure in Asia. I'm wondering, how high can rates go? I look at 30-year, kind of busted through the 2% mark as well.
I think they can go much, much higher. They've got to equal what we're seeing with inflation at the end of the day, because people are not going to be buying treasuries if they see that they're only getting 2 or 3%, but inflation is 7, 8, 9, 10%. So at the end of the day, those rates have to go up.
Okay. Well, with higher rates, the traditional thinking would be that, tech would underperform, which is why we've seen quite a bit of volatility in the NASDAQ, for example, of the last few trading sessions. And then, have that broader rotation. Are you subscribing to that broader rotation?
Well, I think what's happening is that those tech companies that have not been making money, they're going to be in deep trouble. Those stocks are going to go down in price. But companies that are having a very good return on capital, paying dividends, have a good profit increase, those companies are going to be outstanding. They're going to be outperforming. So there's going to be a strong differentiation in the market, if you will.
So does that mean you're picking up tech, but selectively? You're not necessarily chasing a thematic rotation?
At the end of the day, tech is here to stay. There's no question about that. There's going to be increasing emphasis on tech in every direction. You must remember, every industry is being influenced by tech. You know what's happening in semiconductors, and all these stocks are going to do very well if, and that's the big if, they're making money and they're increasing their earnings and have a good return on capital. Otherwise, companies that are losing money, that have been sort of speculative, the IPOs that came on that were losing money, they're going to be in deep trouble, I believe.
In a world of higher rates and inflation perhaps coming back under control, although, this is up to contentious debate for sure, but let's go with that kind of scenario at the moment. In a world like that, gold could stand tall again, potentially not. That's what the Markets Live team is asking. What is the fate of gold in 2022 amidst this shifting macro picture?
I think gold will be doing quite well. It's not going to skyrocket because you have a situation where if people see what they're getting in the bank in terms of interest rates going up, then gold will be less attractive because gold does not pay dividends or does not pay interest. But I think at the end of the day, gold will hold its way. And as I said, it's very important to have some gold in your portfolio, but it's not going to be a speculative boom in gold, in my view.
We'll get to China in a moment and emerging markets broadly, but in terms of the geographic differentiation, when you talk about some of the opportunities in the market, Europe vis-a-vis the United States, what is the split in an allocation?
Well, United States, of course, is the winner at the end of the day because they are, it's the economy where most of the large companies, global companies are located. And a very important point to make about the American market, and that is many of the American companies are actually emerging market companies because a large part, if not a majority of their earnings and their production is taking place in China, in India, in Vietnam, or all these emerging countries. So no question, the allocation in America should be higher, certainly higher than Europe.
When you look at the China story, there are some major risks that have kept quite a bit of foreign capital away, especially out of the United States and Europe. Run me through your thinking on the China opportunity set at the moment.
Well, my feeling is that the crackdown, so-called crackdown by the Chinese regulators has been a good thing because there's no question there was a little bit of a Wild West atmosphere in the Chinese market for quite some time. I mean, you can look at what these property companies were doing. They were not only in property, they were all over the map, buying football stadiums, et cetera, et cetera. So there had to be some kind of a crackdown and regulatory emphasis on the part of the Chinese government. And I think what they're doing is a good thing from a long-term point of view. Of course, from a short-term point of view, it hits the index because you get the big boys like Alibaba, Tencent coming down dramatically. And of course, that affects the Chinese index. And by the way, it also affects the emerging markets index, which is down because of China. But at the end of the day, we're very interested in keeping our watch on China, particularly in the medium and small cap area, because I believe with a more level playing field, the medium cap companies in particular will do much better than they have done before. So I think, generally speaking, the picture forward is good.
Is there any hard rule then as you approach these sort of medium-sized companies, medium-cap companies as you were describing them, sort of maybe stay clear of property, maybe steer clear of banks? I mean, if you had to pick a sector within that space, which one would it be?
We're looking at tech in particular in one area, not only software, but hardware, and also medical services, because as you know, there's a growing awareness in China about the need for medical services with the aging population, et cetera, and some consumer, because a consumer will be there in China from a long-term point of view, so we want to be in consumer as well.
Mark, you've seen many of these cycles over the years in emerging markets with higher yields from the United States, or globally for that matter. That's actually usually a negative for EM. And yet there are some pockets in the market conversation that's suggesting it could be quite a strong year for 2021, you know, whether equities or bonds for that matter. What's your read on that?
You know, it's really interesting. Everybody talks about interest rates and higher rates coming and so forth. But at the end of the day, if you look at the correlation between interest rates and movements in the stock market, it's very, very low correlation, regardless of where you are. Whether it's the US, Europe, emerging markets, so forth. So at the end of the day, we're not worrying about negative rates. In some ways, it's going to be a positive because those people who have been getting negative rates in their banks or no interest rate at all to speak of are going to be looking at the market. And therefore, at the end of the day, I believe that the emerging markets will do fairly well going forward.
When we catch up, Mark, oftentimes you hold a call or a view that's, let's say, a little bit more exotic and goes into the less covered spaces of emerging markets. What's currently on your radar? If you had to make one recommendation that say, you know what, that's something that could surprise quite a bit to the upside. Yes, with quite a bit of risk, but also quite a bit of upside.
Well, if you look at our portfolio, you'll see India is right at, up there with Taiwan. So those are the two that are particularly interesting to us. There's lots of good companies with good returns in those markets, but we're also invested in Turkey. As you know, Turkey's been hit with a terrible devaluation of the Turkish lira. But at the end of the day, there are some very good companies there that are making money on the back of a weak Turkish lira because their earnings are in US dollars and foreign currency. We're also in South Africa, some interesting things happening now in South Africa. If you look at the political environment there, it's changing quite dramatically. And Vietnam is also at the top of our list.
Yes, and the Turkish Stock Exchange, the Istanbul Stock Exchange, is actually the best performing index globally as we sort of begin or get into the second week of 2022 now. Mark, we've talked quite a bit about EM. I'm wondering whether you're making space for some frontier market excursions as well, or whether you're just focused on EM.
We're definitely looking at frontier markets. In fact, in our portfolio, we're in Kenya. As you know, they have some incredible things happening in the technology area. M-Pesa, which was started by Safaricom, has been doing very, very well. And that has been sort of a benchmark for money transfers globally. People are looking at that and saying, hey, this is quite a development. So in these frontier markets, the impact of technology is quite interesting. And it's now having an incredible impact on those economies, a very beneficial impact, I might say.